Your continuous support is helping me to continue this nice series. So welcome folks to episode 10 of ICT's 2024 mentorship. In this video, I'm going to explain my understanding after watching ICT's 3-hour 22 minutes video. I will try to give you the key point I got from that specific live streaming. And if it is important for you, don't forget to write it down to your notebook. If you think that it's not going to help you or it's not important according to your understanding, then you can throw it to the dustbin. Okay? Just don't forget to give me the thumbs up and don't forget to subscribe to my channel if you are new, as I'm providing you the most important information. If you have any kind of doubt after watching this video, though I don't think so you will have any, still if you have any kind of doubt, don't forget to let me know your doubt to the comment box. So let's go to the video. This is the hourly chart for Nasdaq. When you will see that this type of big run, see this big run, never ever try to chase that run. This is the first advice I got, which is important from ICT's episode 10. Please don't try to chase that run. Instead, try to focus on the fluctuation price action. That means when market is not one-sided. Instead, it is something like this, okay, something like that, or maybe here, this type of fluctuated market. You will focus over there because this type of market is much more easier to trade according to ICT's concept or according ICT's concepts. Instead, comparing with this type of one-sided run. That is the first advice I got, and please keep that in your mind. This is extremely important. Now I'm going to 1 minute chart, and I will stay all of my time in 1 minute chart. Here I have actually found a problem, and that is this is the opening gap from Thursday. You can see this is the opening gap, opening range gap high, opening range gap low. If you go to your regular trading hour, and from there you can see this is the closing of Wednesday 5 p.m. This is the opening of Thursday 9:30 a.m. So there is a opening gap. This is how you are going to mark your opening gap, and you will keep 2 days opening gap. That means if you are trading in Friday, then you will keep Thursday opening gap and Wednesday opening gap. So these two opening gap and also the Friday opening gap, you will have the Friday opening gap as well in your chart. You will have those type of opening gap in your chart. Now, what is the opening gap and opening gap range? I'm going back to, okay, let me actually first come here and let me tell you the doubt. This is the opening gap high, right? This is the opening gap high, and then market went higher. Maybe until that area or somewhere. You will mark the high around that area. Wherever your high is around 10, you are going to mark that high. Here, this is the 10 candle. You can see this is the 10 candle. This is the high. I have just marked that high, and I would love to show you over here around that area. This is the high, and this is the opening gap high. Until 10, market reach until that area. But in ICT's live, he shows that the high is little higher. Now I really don't know how he marked little higher of that specific level or that number. You can see it's 19475.75, but in ICT's live it is near about 19482.50. So little above of that line. I really don't know how he has marked around that area. If you can find it out, don't forget to let me know. Okay, I am really interested to know why my line and ICT's line is different. So far you have learned that opening gap and opening gap range. Opening gap is actually the gap, and the range is from the gap to until the high. The highest high market has made in until 10. Okay, so 9:30 to 10, the highest high it is going to make, that is going to be your opening gap range. This is the range and this is the high. Now I'm going to remove this line. So this is the opening gap range, and as per ICT's stream, you will see that this line and this 25% is overlapped. What is that line? If you go to your weekly chart, so let me go to my weekly chart, and in weekly chart, if you mark the low and the high, just let me mark the low and high. So here, this is the low and this is the high. This is the 20%. You will mark 20% and the 30%. I didn't mark the 30% because market didn't go below this 30%. So remember the number 19449.50. 19449.50 is the weekly range, 20% here, 20%. Okay. And if I go to 1 minute chart again, then here, this is that 20% line. Okay. 449.50. This is that 20%, weekly 20% range. In ICT's live, he showed that this 25% of that opening gap, opening range, and that 20% of the weekly range are at the same level. But unfortunately, my one is little lower. This 25% of the opening range is little lower of that 20%. Please don't forget to let me know if you find out why it is little lower. Okay, I mean why it is little lower, not here. Now I would love to tell you one more thing, and which is actually so important. Some Friday you should not try. You should not trade. When you should not trade? In Thursday, if you see market has traded the 20% or the 30%, that means upper third of the weekly range in Thursday. If you see that market did that in Friday, that is going to be low probability. If you see in Friday market didn't come and didn't make the TGIF. This is called TGIF. That means market will trade until the 20% to 30% range. If market doesn't do that in Friday, then you will expect that this is going to happen in Monday. So this is also a kind of information. Please don't forget to write the notes. When market has done this 20%, when it has done it around 9:30, okay, so around 9:30 market has done it. When market has reached until that 20%, that means that TGIF is finished before even starting the 9:30 open. When TGIF is finished, then this type of back and forth, back and forth, back and forth, this type of price action is expected. Yeah, obviously market can go higher and make that all time, I mean this weekly range high one more time. It can take that on. Obviously it can happen, but most of the time when market actually reach until a certain level, and that certain level is the upper third. If you just divide your weekly candle into three positions, okay, so lower third, middle third, and upper third. The upper third specifically from 20% to 30%. I just didn't mark the 30% because market never came until the 30%. If market can reach until that portion, then you should expect this type of price action, back and forth price action, which is really low probability as per ICT and as per me as well. But yeah, you can do the backtest, and if you want to get some perfect, confidence or something from there, obviously you can do the backtest and you can see it is actually working or not this way. If you think that it's not working, you can trade, and if you see that no, after when market reach until that 20% or 30% or in that specific range, the price action is really messy, then you will build a confidence that no, I am not going to trade in that specific time. This is the 9:30 candle. Look at this 9:30 candle. So if you see this 9:30 candle, so I'm going back to my regular trading hour. This is from Friday. So this is the closing of that 9:30, I mean that specific Friday opening range. So here until the open to that closing, this is your new opening range gap. How far this gap is important? Until 10. So here there is my 10. Okay. So this is the opening gap. Now where is going to be your opening gap range? See this high, this is the high, this is the low. So this is going to be your opening range. This is the opening gap, like here. This was the opening gap, and this was the range. Here, this is your opening gap, and your opening range is from here to here. Because in the time frame 9:30 to 10, this is the highest high, this is the lowest low. So you are going to mark those two lines, those range as a opening range. Okay. I'm just removing this box. Instead of that box, I am going to just mark this low so that you can remember that this is the opening gap low. Opening gap high. Okay? Just remember that line, and I'm just going to change the color. What type of color? Just this one. And I'm going back to electronic trading hour. So until now, I hope that you already got an idea about opening gap and the opening gap range. Okay. Now around 9:30, what happened? Market went lower. Take this relatively equal lows. So see this low and that low. Trade that high of that opening range from Thursday. Trade that one. Then it came back again. Where did it came back? To that opening range high. Went higher. Where did it go? To close that opening gap, which is created by today. Okay, this is the opening gap high. Remember, this is the opening gap low from Friday. So market has closed that opening gap. Above this opening gap, you have this perfect new day opening gap. See this new day opening gap? This is the new day opening gap low, this is the new day opening gap high, this was your new day opening gap, opening gap. How long you are going to keep that? 5 days, 5 trading days. Now I don't need that opening gap high because you have already seen that it has traded that opening gap high. So I'm just going to close that one. Now here is the part, time and price. What do I mean by that? When market went lower and market came until that area, look on your before. Here you will see a gap, the old gap. I'm just going to mark that gap. So let me mark that gap. Market has traded that gap. So I'll keep it over there. This is that gap. Market has traded that gap. After trading that gap, what should you expect? That market is going to fall. How far it can fall? For this relatively equal lows. See this relatively equal lows, and until the 50% of that range, opening range from yesterday. That should be your expectation. So you will start to look for any kind of setup, sell setup over there. Now from yesterday's stream, that means Friday's stream, ICT actually told that when you are in 1 minute chart, in time, not now, when you will understand, you will have a better understand about the market, you are going to trade maybe 6, 7, 8, 9, 10 trade in a single day. Every single time you will try to catch 15 handle to 20 handle. For Nasdaq, for E-mini S&P, it's going to be just 5 handle. So you are going to take a lot of entries, near about 10 to 12 entries, something like that, or 8 to 10 entries in a specific day from 1 minute chart, because this is a very small time frame. In this time, you are going to take some losing trade, you are going to take some winning trade, and at the end of the day, if you really know what you are doing, you are going to be the profitable trader. Okay, so that is for sure, because it is really it is proved. Okay, I can just tell you that it's proved. So over here, when market has traded that area and then market went lower, market ICT was looking for a sell around that area. Now all you can see that market went lower again, went higher again. Okay, so when market went higher again, this whole area and went through this old parallel gap. Look, this is the first candle when it went through this old parallel gap. It tapped to this old parallel gap. Where did it reach? Until this new day opening gap. See over here, it reached until this new day opening gap. When market went above this new day opening gap, and it has made this relatively equal highs over there. So let me mark that relatively equal highs. That was the relatively equal highs. If you look before that relatively equal highs, you have another relatively equal highs over there. So there is your another relatively equal highs. Those were the buy side liquidity. Okay? So when market actually came here and tapped to this new day opening gap again, ICT started to think that market is going to take that relatively equal highs, and finally that relatively equal highs is going to be taken. But unfortunately market went lower. He actually marked this parallel gap. So let me mark that parallel gap as well. That was the parallel gap. That was his last line. Think that market is actually going higher from that specific parallel gap. What market has done? Market went through this parallel gap. Now, if you ask me, this is my opinion, not ICT's opinion. Yeah, ICT did the perfect thing. What he has done, when he has seen that market went and closed above this new opening gap from 1 minute chart, and it tapped to this new opening gap and also this bullish parallel gap, it should take that buy side liquidity even before falling. So I will go for a buy over there. Maybe my stop loss is going to just below that candle which has made this parallel gap, and I will be stopped out over here to that specific candle. I will be stopped out over there. When I got stopped out, and then I have seen that market went higher again one more time. Am I looking for buy again? No. Why? Because this parallel gap should be unfilled. Above this parallel gap, I had this new opening gap. Market should close. Market should trade that new opening gap. It should leave even. If it just leave one tick open over there, I'm good to go for buy. But it has closed this parallel gap perfectly. That means there is no breakaway gap. This is the reason breakaway gap is important. Okay, so over here when it closed over there and come back again, trade that new day opening gap. Now market is actually using this new day opening gap as an inversion new day opening gap. Market went lower again, trade that specific parallel gap. So let me mark this specific parallel gap over there, and let me actually change the color and the depth. Okay, I'm sorry for this small thing. So over here, when market has traded that gap, also this inversion parallel gap. Now this breakaway gap, which I was thinking that market will tap and take that buy side liquidity. Now market is going to use this as a inversion fair value gap, this one, okay, as a inversion fair value gap. At the same time I have this sell side imbalance, buy side inefficiency. Market went higher, trade that fair value gap, both of those fair value gap went lower. Look at this candle, this is the order block. Over here ICT told that he wanted to see the when this candle has made this order block, he didn't want to see that market will even touch the 50% of that week. Okay, it will just trade the lower lower part of that week 50%, and then it will fall dramatically. How far it can reach? See this old fair value gap, remember this old fair value gap, from there it should reach until this high consequent crossment or the low. Until this fair value gap it should keep until that area. So if you can frame a trade from there to there, it's near about 10 handle. So from there to there, 10 to 15 handle, something like that, you are going to get that winning trade over there. Then what do you see? Market fall. Where did it came? To that specific imbalance. So let me mark that imbalance. This is the imbalance. Why you should look for that imbalance? When market is actually falling, you should first look for some kind of relatively equal lows or the imbalance. As you can see, you have some relatively equal lows over there. Then here, and finally you have this imbalance around that area. So market came here exactly where it has came. Now all of this price action, see all of this back and forth price action, this is absolutely balanced price action. Okay, so if you just mark the high and the low of that specific consolidation and turn it to your right, look, it came. Let me change the color so it will be easier for you to see. Sorry, just a second. So let me make it little. So here, this is the 50% of that specific consolidation. So market actually came here to that specific consolidation, 50%, then went higher again. Where did it came? To that specific inversion fair value gap, and then come back again, started to consolidate around that area. Now, this is the market where you should think that you are going to, you are just not going to participate in the price just thinking that I'm not going to take loss. If you are experienced trader, then you are going to trade in this market even after reaching for that 20% of the weekly range. If you are experienced, then you are going to think that, yeah, I will try maybe 8 to 10 times. I will take some losing trade. I will take some winning trade. At the end of the day, you will in green, because you are working with the concept, and that concept is obvious, and that is going to repeat every single time. Now, if you are with me in my live in that specific Friday, you already know that how beautifully I outlined all of this price action. Obviously, there was losing trade. Obviously, there was a lot of winning trade. Okay, comparing the losing trade, there are a lot of winning trade. I outlined that trade, then this buy, a lot of things I outlined over there. But here in this video, the main concept is when market actually trade the weekly 20% to 30% range, after that, you should not think that market is going to give you some kind of very clean price action. You should be prepared this type of very sloppy price action. Okay, very sloppy price action. Now, here I'm going to give you another gem by watching ICT's video, and that gem is extremely important for you, and that is when you should take the partial. When market came here around that area and here, okay, and then come here, finally fall over there. This is that old fair value gap. Okay, so around that area, this was your old fair value gap. Just let me make the color little whiter. Okay, so here, as you can see around that area, when market came here around that area and went higher again, see this specific candle around that area. When it tapped over there, you should take another buy around that area. Okay, you should go for another buy. How far you are going to take that buy? How far you are going to hold that buy? Until this high. So I'm just going to mark that high. You should think that market is going for that buy side liquidity. Let me remove this one. That should be your buy side liquidity. Why you are going to think like that way? Because market has traded the 50% of that consolidation area. There is nothing. There is just nothing that's for market can reach or to take. I mean, this type of consolidation area. There's just nothing. It reached until a certain level, 50% of that consolidation area. It should keep going higher now. And when market has closed above this old fair value gap, look, old fair value gap, you will start to think that now market is actually reaching higher. So maybe you took an entry over there around that area, and your stop loss is just below this candle here, just below that candle. Your target is over here. What you are going to do, you are going to mark the 50% of that area. Okay, so this is the 50% of that area in this specific price term. What do you have more over there? See this imbalance over there? Look at this imbalance. Let me actually remove this one and let me mark this imbalance over there. So here, this is the imbalance. Let me mark it that here. This imbalance, that imbalance, both of them are almost, they're overlapped with one another. Okay, when it tapped over there, it should keep going higher to take that buy side liquidity, but you have to take a partial whenever market will go above the 50% of your range. If you see any kind of swing high has created or it has already over there, you will take your partial. So what do you see? Market actually tapped over there. There is a swing high around that area. So what you are going to do? You are going to take a partial above this swing high. You will take a partial over there. Now at the same time, as you can see, this is also a inversion fair value gap around that area. You can use that concept as well if you want. There's a lot of things you can see over there, but as per ICT, I wanted to clear that this whole area is your target. Okay, so let me put it in the right way. This is the whole area you got a chance to take partial. Now above this high, above that specific high, when market went above that high around 50%, you will take the partial over there. That should be must. You have to take the partial over there. Then market went through this fair value gap one more time. Trade until the 50%. See, until this 50%. Maybe you took the partial over there, you got stopped out the break even, and you saw that market went lower below this fair value gap. Respected that consolidated cost point. What should you think? It is going to take that low. See this low? Market is going to take that low as a sell side liquidity. Then you are going to take another entry over there until this sell side liquidity. Obviously, you need the experience to do this type of things. Otherwise, you have to just think about one simple concept, and that is when market has already traded around Thursday or Friday, the weekly range 20% to 30% in that specific area. You are not going to participate in this price action because you know beforehand market is going to do this type of things, which is extremely dangerous to trade. But if you have the experience, obviously you can take a lot of entries around that area. Some will be winning trade, some will be losing trade. Okay, everything is in line. And what happened exactly to around that area after taking this liquidity? And over here, after taking this liquidity, market went higher, trade that area, went higher again. This is the new day opening gap. After trading that new day opening gap, remove this one. After trading this new day opening gap, went lower, went higher again. Make the new day opening gap around that area. Here is another opportunity to take your entry. What type of opportunity do you have? See this buy side liquidity when market closed above this new day opening gap around that area. Here, when market has closed above this new day opening gap, you will have another opportunity to take that buy side liquidity. So closed here, tap to this new day opening gap, you will take a buy over there where you are going to focus to that specific buy side liquidity. What should be your partial? Look at this whole range. See this 50%. This is the high which has market made. So you will take a partial over there, and around that candle, you will take a partial. You will put a stop loss to the break even, and maybe you will be stopped out over there, but still you will get near about 15 handle. Okay, you are going to get near about 15 handle over there. Or if you just as per ICT actually put his stop loss. Sorry, not there. He just put his stop loss above here. Okay, so he got stopped out and he just didn't want to see that market will go below this volume balance. Market stopped him out. Then boom, market went higher and take this buy side liquidity. So there's some entry opportunity or price action, that is different thing. But the key point in this video was when market has traded some 20% weekly range or 20% to 30% weekly range, then you should expect this type of price action, and you should not participate in that type of price action. That was the key thing, okay, in this episode 10. So I hope that, guys, it's a little bit understandable for you. If you think this is understandable for you, don't forget to give me the thumbs up, and don't forget to subscribe to my channel if you want. So until the next video, cheers.